is becoming very clear to the market, and something that we've been saying for weeks, that investors were entirely too optimistic that the Federal Reserve was going to decrease the Fed rate as soon as March. In fact, their expectations just plummeted from an 81% probability to a 46% probability of this happening, literally in just 1 week. So remember, their expectation was 6 Fed rate decreases in 2024, when the Fed themselves only spoke to 3. That is what moved our interest rates originally 5 weeks ago from 7.1 to 6.6%. Now, the 30-year fixed rate is back up to 6.95%, even as inflation continues to decline. So in this video, I want to talk about what happened this week that moved the markets, and why will housing not be defeated even with higher interest rates. But before I get too far into this video, if you haven't done so already, please hit that thumbs up button down below. And if you're someone who loves content on all things real estate, mortgages, and the economy, be sure to subscribe to my channel so you never miss an update. So this week we saw an exorbitant amount of economic data showing just simply how strong this economy really is. The consumer sentiment came out for December data showing a jump from an index of 69 to 79. Now, while that might not be meaningful to you, I'm going to tell you that that jump was significant. In fact, it jumped our consumer confidence back to a level that we have not seen since July of 2021. Do you remember July of 21? I do. And it was poppin'. So now we're seeing that kind of consumer confidence, which is no surprise then that we saw core retail sales hit an all-time high in 2023. Core retail sales hit an all-time high in 2023. I mean, interest rates were higher. Inflation was higher, yet people were spending money. Now that came out in the GDP numbers that just came out. We saw a higher than expected number with a GDP of 3.3%. We were expecting 2%, and if you remember, the third quarter 2023 was a 4.9%, which was also unexpected. Now, if I think about this, the GDP from the third quarter to the fourth quarter actually went down. So is this the beginning of a recession? I'm not thinking it is, and certainly if it is at all, it's a soft recession, as the GDP is slowly coming down from that exorbitantly high number that it was in the third quarter 2023. But a GDP that high is still strong. Not a surprise, because Americans are feeling exceptionally wealthy. I mean, come on, the Bitcoin EFTs just got approved, and the S&P and the Dow Jones Industrial Average had hit a record high at the end of 2023, and it just hit another record high at the beginning of 2024. Like, come on, I'm feeling really good and quite wealthy. We're seeing that. So even though 11,000 people were laid off so far in January, as the tech companies are starting to realize that they hired too many people during the pandemic, and now everybody's focusing on AI. So initial jobless claims did pop up slightly, but only 13,000 more than expected. For 11,000 people being laid off, that kind of makes sense, but nowhere near the numbers that we saw 1 year ago. And another number that really popped out to me is the GDP deflator number. So inside the GDP, there's a PCE number, which measures inflation. Remember the Personal Consumption Expenditures Index. There's a PCE number inside GDP. It's a lot of letters. But that PCE number came out at 2%. Okay, we just hit the Fed target, 2%. And the GDP deflator number hit 1.5%, which is less than the 2% expected. All of that showing that inflation is coming down. So people feel more wealthy. They're spending more. Oh yeah, credit card debt is still way over $1 trillion. The savings rate is less than half of what the historic average was. And inflation is coming down, so I can buy more. So I don't know. Soft landing, no landing, I'm not feeling it. And if any of that trips you up, if you missed the Econ 101 video that we just put out, you definitely need to watch that, where we dive into all of these metrics and what they mean and how they relate to the real estate market itself. So now let's turn our attention to the real estate market. So new home sales just came out for December data, up to an annualized 664,000 new homes sold. This is up from a staggering decrease just 1 month prior in November, down to 590,000. So it crushed the end of 2023. No wonder builder confidence is up, in addition to the 2-1 buy downs and the forward commitments that they can do. Mortgage purchase applications are also feeling the gold. They are up 8% week over week. Now we're down 18% year over year, but if I scroll back to January 2023, there was a massive uptick because we had seen rates drop at the end of 2022. But the rest of 2023, mortgage purchase applications were below where they are now. So we're kicking off a very high demand year. So it's no surprise that Realtor.com just came out showing that first-time home buyers, 61% of those surveyed said that now is a really good time to buy. Wait a minute. Do they remember that interest rates were above 6.6%? They don't care. So buyers are starting to get used to these higher interest rates, and they're going to come out on top of limited supply. And limited supply will be the story that we continue to tell for years to come. I mean, remember, of those people who own homes that have mortgages, a majority of them have interest rates locked below 6%. And we just hit a record high of 40% of all homeowners don't even have a mortgage. Here in the Denver metro, that number hit an all-time high of 27% of all homeowners. I mean, that's safety, stability, and security. Those kinds of things are going to continue to support an upward pressure on our home prices. Nationwide, we continue to see record high home price appreciation. Here in the Denver metro, we're only 1% off our record high in 2022. Now, we know we saw a dip in home prices, but we've regained all of that except for 1%, which I feel very strongly we will do in 2024, especially if you consider that only 1.5% of all of our homes in Colorado are underwater. Those are the homes that were purchased at the end of 2021, the beginning of 2022, during the peak. And we have delinquencies that I have to go all the way back to 1999 to see credit delinquencies as low as they are today. People are feeling good. They are not having to file for bankruptcy or foreclosure or even do a short sale. For the new buyers who are coming into the market, our continued credit availability index shows simply how tight underwriting guidelines are today. And why does that matter? That matters because those new home buyers are stronger than they've ever been. In fact, I have to go back to 2008 to see this tight of guidelines for buyers coming in to the market. And for those of you in Colorado, we will continue to see strength in our housing market as our largest population right now is between the ages of 28 and 32. And an interesting stat is we're expecting another 40,000 people net migration to move in to the Colorado market. Those folks moving into Colorado will be looking for housing. Yes, of course, some of them will be renting, but also those will be looking to purchase. So 2024 will continue to have volatility. But a strong economy and slowing inflation will provide consumers greater confidence despite today's higher interest rates. So if 2024 is when you are looking to explore getting into a home of your own, I would ask that you please reach out to the Rueth team, as we want to be a guide for you as you open up the opportunities that only homeownership provides. And in the meantime, I hope that you have a fantastic day, and I'll talk to you soon.